Hello, everyone, and welcome to tonight's webinar. Unlike other nights, tonight is going to be something a little bit different. We're going to talk about ESG investing. Also, unlike other nights where we maybe go for an hour or often past an hour, tonight will be 15, maybe 20 minutes, if that. Anyways, let's dig into ESG. Before we start, a little bit about the speaker, which is myself, Derek Eichenwald. That's me. For those of you in tonight's webinar who don't know me, I have the distinct pleasure of serving as the CEO and Senior Investment Executives with Triumph Capital Management. Triumph Capital Management is a registered investment advisor located here in Denver, Colorado. Just some important disclosures. Tonight I'll be making perhaps some forward-looking statements about the markets, the economy. Obviously, we'll be talking a lot about ESG investing, what it is, why you keep hearing about it in the news, so on and so forth. And we'll talk about some of the trends underneath ESG investing. Nothing that I'm saying is a recommendation for investing in ESG or a non-recommendation for investing in ESG. Tonight's presentation is really designed to be educational in nature. So you probably might see Murray walking around. That's Murray the dog. What is ESG? Let's unpack it. The first thing is the E stands for environmental, the S stands for social, and the G stands for governance. And there you have environmental, social, and governance, or ESG. Let's unpack that a little bit more. It really refers to a set of standards for a company's behavior used by socially conscious investors to screen potential companies to invest in. This exists in both the stock and the bond market, as you will see tonight. When it comes to the environmental criteria, it looks at companies and looks at, what are their policies for addressing the environment. Climate change, for example, is one of them, or what they're doing. Have they had any history of violating any type of environmental standards and that type of thing. The S, or social criteria, examines how that company deals with its employees, suppliers, customers, and the community where it operates. And lastly, governance. It deals with the company's leadership, its executive pay, the disparity between executive pay and worker pay, audits, internal controls to perhaps look at what they may be doing to the environment, look at how they're affecting the social area in which they live in. And there is ESG. We put together this little chart to kind of show you this. Environmentals, things like air pollution, wastewater management, so on and so forth. Social, product safety, local community impact of where the company's operating or where they do a lot of business. Governance, who's on their board, what's that look like? Executive compensation, capital allocation, how they allocate corporate capital. So let's talk about tonight some 7 essentials of ESG. We'll talk a little bit about ESG considerations in affecting consumer preferences and public attitudes. We'll talk about our policymakers in setting environmental and social goals and how that affects ESG investing. We'll talk about, for some companies, this may be a headwind, but it also creates a significant opportunity for those companies who are perhaps on the forefront of change. We'll also talk a little bit about how it's not just about the E, or environment, but how social as well as governance are also growing in popularity. You'll see some charts on this. We'll talk about how ESG is affecting the investment landscape and how it's changing how the investment landscape actually works. So let's start to dive into this. It's interesting doing this presentation this evening because yesterday I was listening to a podcast, and it was the Joe Rogan podcast, and his guest actually and him spoke about ESG investing for about a half hour. Interestingly enough, Elon Musk. Most of you would think, hey, Tesla's got to have a great ESG score. Elon Musk famously came out and said the S inside of ESG stands for satanic, okay? More and more on the news, you're hearing about ESG and how it's all baloney, or how maybe it isn't baloney, and so on and so forth. I'm not here tonight to say that Triumph or myself agrees or disagrees with ESG, but what I am here tonight to do is to actually explain to you what ESG is. And so, the first thing is that there's this ESG scoring system. There's companies out there, companies such as MSCI. MSCI not only handles a whole bunch of stock indexes, but they have over 200 analysts around the world. And out of those analysts around the world, they come up with a scoring system. What you're looking at here is what a score for Coca-Cola looks like. You can see that MSCI gave Coca-Cola, and this is a recent scorecard, a AAA rating. They go to look at every company, not every company, they screen about 10,000 companies in different industries, and they get a score, AAA being the best. You can kind of see down here. They all have their own scoring matrix. This is maybe one of the problems. When I say they all have their own scoring matrix, what I mean by it is this is a page right out of MSCI's brochure. It talks about how they go to give a company a score. You could go and Google this. You could type in MSCI ESG ratings, and you can find this information right online. We're all familiar with the famed Morningstar. Morningstar forever and still today ranks mutual funds and ETFs. Morningstar used a scoring system, or uses a scoring system, 5 stars for mutual funds or ETFs that outperform their peers, all the way down to 1 star. I like to say, you know, the 5 stars an A plus, the 1 stars an F. But where does that grading come from? It's very important to remember, and I think using that classroom analogy will give you an idea. You may go and Google and find a 5-star mutual fund, but you may find that that 5-star mutual fund rate of return was only maybe 4%, versus some other fund that you find that only has a 2-star and their rate of return is 25%. Well, let me unpack that for you for a moment. The first thing that happens is Morningstar says, hey, we're going to look at every mutual fund in its mutual fund class. In other words, they'll say, you fall into large cap growth. You fall into small cap value. They're only grading that mutual fund for its classroom. In other words, you're going to grade 6th graders to 6th graders. You're not going to put a 1st grader in there to the 6th grade class and give them the same scoring system. No different than how Morningstar for years used that 1 to 5-star scoring system for mutual funds and for ETFs. Today, they score companies on ESG risk rating assessment. And you notice here, you're getting a risk rating for Coca-Cola. Interestingly enough, I just showed you a moment ago, MSCI gave Coca-Cola a AAA rating, whereas Morningstar gave them basically a C or a C plus. You notice here they gave them a medium rating, only 3 globes. That is interesting. Again, they score funds 5 stars to 1 star. And for their ESG ratings, they use these new things called globes, as you can see on my screen. 5 globes being the best, 1 globe being the worst, 3 globes being, as you can see, someplace in the middle, like a C grade. Morningstar uses a complete different set of methodology to come up with a scoring company for, to come up with a grade for a company's ESG score. Also, one that is free and you can find online, if you go to Yahoo Finance. Now, Yahoo Finance does use a third party. They use, I forget the name of the third party that they use, and they don't cover every company, but this is a snip that I took just today on Coca-Cola. And you can see Coca-Cola here, they give them a median risk score, ESG score. You can see the different, and you can also read, if you go to Yahoo Finance and you click on, you type in a company's stock symbol like KO for Coca-Cola, and then you click on Sustainability, this will come up, and these are all clickable, and you can read about how they go and grade a company. So quite interesting here, as you can see. You have both Morningstar and Yahoo's third-party researcher giving Coca-Cola a C, C+, whereas you have MSCI, one of the leaders in scoring ESG, giving them a AAA. So I think that can cause some heartburn for investors right off the bat because, hey, what criteria am I being graded under? Now, this isn't what you're hearing on the news. You obviously don't see politicians out there yelling about the grading system. What you're hearing on the news will be unpacked as we go through the rest of tonight's kind of educational meeting. So, interesting. ESG has grown substantially. If you look here on the graph on the left, it's saying to you, they looked at Germany, the US, the UK, Australia. They asked the question, they said, they asked this question, do you mind paying more for products that are good for the environment? And if you noticed, a bunch of people answered that, they don't mind paying. People said, I'd rather spend more money. In fact, an overwhelming amount. You can see the agree to disagree. You can see the growth of ESG products. What I mean by the growth of ESG products is, in my business, more and more mutual funds coming out saying, hey, the companies inside of this mutual fund all meet this different ESG criteria. If you go back to 2018, about 16% of the marketplace, and now you see 50%, and the study gets a little bit deeper. If you expand that to other countries, Hong Kong, Japan, Korea, Singapore, China, so on and so forth, you can see that when the survey was taken, which consisted of 8,681 consumers across 22 different territories, you can see an overwhelming amount of consumers said that they'd be willing to pay more for things that were ESG friendly. And why does that matter? It matters because consumers are making decisions, okay, with suitability in mind, and they're voting with their wallets. Now think about this. Think about what I do for a living. Think about what you're doing on the call today. You maybe saw this and said, hey, I want to join. I heard about that in the news, so on and so forth. And we're going to get to, on our next slide, what policy makers are doing. But think about it, just in a simple survey, if you stood out here in Denver on the 16th Street Mall and grabbed 300 people, and you found that something like 50 to 60% of them all answered, yeah, I'd pay $1 or $2 more if there was more corporate impact, more ESG impact. I'd be willing to do that. And over time, we're seeing consumers make that decision. And remember what I do for a living. We look for companies, okay, that share price are going to go up. How's share price going to go up? Well, if more customers are aware of that company doing well in the community, they may direct their dollars there. Policymakers. What you're hearing in the news, so on and so forth, there's a number of things going on. The first thing that you read about is you read about countries' path to net zero. Governments around the world are really being committed to cutting their greenhouse gas emissions. In fact, as you hear on the news, so on and so forth, you see companies all the time, countries all the time, talking about this path to zero greenhouse emissions. Well, if you think about that for a minute, if you think about that for a second, how are countries going to reach that? Just think about here in the US. I mean, of course, the US government does something, okay? They do something, but really think about it. You have all of these companies out there that do things, right? You have little restaurants, you have companies in manufacturing, companies in healthcare, transportation, so on and so forth. However, the government's committed to it. Well, how is the government going to commit to net zero greenhouse gases if they don't influence the companies in their country? Okay, and why this matters is because altogether 80 countries representing 75% of global greenhouse gas emissions have set ambitions to net zero emissions in the coming decades. It's not a process that's going to happen overnight, but it's a process that governments have committed to and therefore will pass bills to direct the companies that exist inside of their borders to zero greenhouse emissions. How will that affect those companies? How will that affect the profitability of those companies? Are they good or are they bad to invest in? As you can see here on the left-hand side, you have the global energy mix, okay? What this is showing you is this is going all the way back to the 80s. And in the 80s, what you can see is globally how much oil that we used. Now, obviously, global consumption has been coming down, and you can see that shown to you in the solid line. You can see on the dotted line that is expected to be where global consumption goes for these different types of energy solutions, such as oil, coal, gas. Interesting, look at nuclear and hydro, okay? And look at renewables. Now, some people laugh at this. We have experienced this, but look at that curve. Well, 10 years ago, we talked about the price of solar, the price of wind, the price of natural gas just being too expensive. As you can notice here on the graph on the right-hand side, what we've noticed since 2010 until current date, look at that cost of solar. Solar is a renewable coming way down. Look at the cost of natural gas, right? It's much higher back then. Look at the cost of wind production coming way down. Now listen, whenever I bring this up or I talk to folks, people say, yeah, you have the windmills and they're killing bird populations and everything else. I understand that. I get that, okay? What I am saying, however, is I am saying that the cost for wind, the cost for solar has come down. Because of government policies pushing those things, you've had massive amounts of investment in those areas. And when you have massive amount of investments in those areas, costs tend to come down. Think about trying to travel across the country in 1920 versus trying to travel across the country today. It's much easier. Investment was made, railroads were built, highway system was developed, costs came down. We'll keep looking here. If you notice, this again goes back to 1970. Look at the use of oil and coal and gas. It was almost 100% of the global energy mix of how economies ran. You notice that those areas have been coming down substantially throughout the 90s into the 2000s, and here we are today. You get to a net forecast and you see that those renewables start to represent and take away a lot of market share from two areas in particular, gas and coal, and eventually oil, okay? Now, is this to say that ExxonMobil or Chevron or whatever are bad companies to invest in because they're oil and gas producers? No. Exxon and Chevron would be the first ones to say to you, we are an energy company. If energy, such as in renewals, starts to become more attractive, you will see us as a company start to produce and sell more renewables. And oh, by the way, they are. Why does this matter? Okay. The shift to renewable may pose a challenge for some industries, right? It may pose a challenge to some industries. I believe I saw on the news last night that in the state of New York, they're mandating that small businesses and all businesses that use gas for cooking get rid of it and they go to electric. Okay, they go to electric. And so, if they go to electric, will that increase their energy cost, their bill? Will their food not taste as good? You may have your feelings about that. My point is the government is passing bills to get to net zero greenhouse emissions. Where can those investments be made? Of course, at the end of the day, that's my job, and also here to educate. I'm just saying, what is this ESG? Okay, right, wrong, indifferent, agree, disagree, not taking a position. If we look at this and you start to really think about it, look at this graph here. This is simply showing you global investment in energy transition in billions of dollars. Let's go back 20 years ago to 2024. 2024, there was about a $25 billion investment globally, which is nothing, okay, simply in renewable energies. Well, look at that blue graph growing in renewable energies, okay? And then look at what also got tacked on top of it in 2014 and into today. That is a wonderful looking graph if you're growing anything, if we're talking about the growth of anything, whether the growth of that is bad, okay? I'm just saying this chart does nothing but move from left to right in a very dramatic fashion. In fact, look at 2021, look at that jump. So not only do you see increased investment globally in renewable energy, which is now nearly 400 billion, okay? You also see this new stack on top of there, which is things like carbon capture or electrification or the storage of energy. You know, it used to be in North Dakota. I remember I went up there and looked at oil and gas wells, and they did what was called flaring, meaning what they would take all the other gases that were produced, propane, so on and so forth, they just light it on fire, right? Because they said, hey, it's too expensive to package up, so on and so forth. Storage of such things, they're storing that propane now. Electrification of cars, carbon capture. Today, this represents nearly $750 billion of global investment. So take a step back for a moment and just think about it. You have this enormous growth in ESG. What companies benefit from that? Okay, because you know it doesn't just happen magically. In other words, what companies are in those renewable energy spaces? What companies are in the electrification space? What companies are in the global capture space? Take a look over here at the global electric vehicle sales. If we go back just 13 years ago, they represented nothing. Now, I know some of you might be saying, yeah, they didn't really exist 10 years ago. But look at this dramatic growth of electric vehicle sales. Today, around the globe, it represents nearly 8.5% of all car sales. But look at this leap, okay? If you go back to 2020, it only represented 3.5. Today, 8.5, more than 100% growth, okay? More than 100% growth. Moving right along, you look at this is what we kind of looked at before, but back in 2004, it's a graph that's just showing you kind of the same thing. In 2004, US dollars, 33% was in $33 billion was invested in renewables. You fast forward 16 years, okay, 2020, you notice that right now you got to add these two numbers together because the green area shows you $304 billion in renewables plus another 200 billion in storage, electrification, carbon capture, and other. That totals up to 501 billion, whereas in 04, 33 billion. Ladies and gentlemen, that is an industry that has grown 100% per year for the last 16 years. 100%, it's actually a little bit more than 100% per year for the last 16 years, okay? Why it matters is it's propelling investment opportunities. What companies exist? What companies in here are taking advantage of this huge global transition to net zero and this huge global influx of spending to lessen one's carbon footprint? You see it all the time, okay? Well, it's not just the environment, it's not just energy, okay? There is a focus on social and governance as well. In fact, what you're looking at here is this goes back to 2011, and this brings you all the way up until the fourth quarter of 2022, okay? As some of you may know, companies that trade, publicly traded companies, have what is called an earnings call every quarter, 4 times a year. We're on a lot of those earnings calls. Inside of the earnings call, the company talks about what they earned last quarter, what they expect to earn moving forward, and things that affected their business. This graph here is extremely interesting. It's simply showing you the number of mentions, okay, of diversity and inclusion during earnings calls from 2011 till the last quarter of last year. Exponential growth. Why does that matter? The recent jump in corporate mentions of social issues signal rising interest and regulatory pressure. Again, I bring it back to governments have made an agreement to get to that net zero greenhouse emissions. How are they going to do that? The government doesn't have plants. The government isn't manufacturing. The government isn't transporting. The government is passing bills, and inside of those bills, you see companies reacting to it, okay? ESG is also affecting the investment landscape. In my business, we look at assets under management. In other words, how much money do you manage? That's referred to as AUM, or assets under management. Well, what you can see is, and I showed it to you early, there's a huge growth in marketing products, mutual funds, ETFs, models, so on and so forth, that do some sort of ESG filtering for companies that have good grades, okay? And the amount of money that is poured into those products since 2006, so not too many moons ago, until the end of 2001, again, a graph that is just amazing looking, right? Huge amounts of growth inside of there. When we think about strategy, okay, there's all these different things that exist in ESG investing. You know, it could be such things as impact investing. In other words, what are the social impacts of investing into this fund? What companies do they go to invest in? Well, you see, impact wasn't that much perceived. Why? Because sometimes impact investing, there's no return on the back end. Integration, you can see that takes up about 43% of this massive growth. What is integration? Integration is this. Hey, Derek, I'm an investor. I like what I'm doing investment-wise, so on and so forth. But you know what? Listen, it's my money. I get that the scoring system isn't fantastic. When I say it's not fantastic, listen, it is fantastic. The way that they go through it, the methodology that's put into it, the thought that's put into it, so on and so forth. But you noticed, I just showed you MSCI scoring a company AAA, and then 2 other ratings companies basically giving them a C. So some disparity. But I bet you that there's a whole bunch of companies that get a D. And I bet you the grading system for the Ds, you know, it's not as, you know, you see what I'm saying? Like there's not that much disparity down in the D area. So what integration means is integration is investing with ESG in mind. In other words, a filtering system. Look, we're not going to invest in companies that have Ds. We're not going to invest in companies that have, you know, no ratings. We're going to invest in companies that have ESG ratings of whatever, C or B or better, okay? And that's what integration is. So you're seeing a lot more marketing on that integration side, okay? This is share of total net flows to strategies that incorporate ESG screening. You see in the EU over time, 1970 to 2021, new money, meaning new money that's being invested with companies. You can see more and more of that is being screened. You also notice this huge decline in the United States. You notice not a huge decline in the rest of the world, basically flat in Europe. In the US over the last 2 years, ESG's been in the headlines, ESG's been victimized. In fact, when we sent out the email for all of you to join this webinar, we got some hate email back, like, why are you talking about ESG? And it was like, hey, listen, we're not talking about ESG to take a political stance. We're not talking about ESG to make recommendations. We're simply talking about ESG from an investment standpoint, trying to educate our clients or anyone else who's on the call or the webinar this evening on kind of what ESG is from an investment standpoint. And to also point out that because of government policy, okay, we have nothing to do with that. You all vote, okay? Everyone votes, so that's where your voice gets heard. But because of government policy, be it you agree with the vote or disagree with the vote, these types of things are being pushed out, and it may make opportunity to invest inside of different areas. We'll keep working here, okay? We expect the demand for sustainable funds will continue to increase. Derek, can you screen our portfolio? We'd like to invest in ESG type of companies, so on and so forth. And by the way, it doesn't stop there. If you look at it, this is the demand for bonds. So companies go out there, and companies, as you all know, when they go to borrow money, big companies don't go to the bank. In fact, they can't. Big banks only issue about $250 million of debt. So when big companies say, hey, we want to take a loan, they go to the world and they issue bonds, okay? And when you think about it, it was like, hey, you know what? It's a loan to a company. But more and more, what's happening is when companies are issuing bonds, they issue bonds often, sometimes for a specific project. You know, when the school district, for instance, issues bonds, they may be building new schools. Of course, the school district's paying back those bonds with the full faith and taxability of the municipality. But, you know, companies go out there and they may be issuing bonds for specific projects, so they may be issuing bonds for the entire company. And what's happening is if you see companies that are issuing bonds, you see that the growth of fixed income strategies with bonds that have ESG kind of underlining underneath them has grown hugely. And why does this matter? It matters because it's not just limited to equities. Environmental and social projects have increasingly access to finance. You know, it's people today, they want to buy bonds, and sometimes they say, hey, listen, I want to focus on bonds that have some of that ESG strategy underneath it, right? Okay. So we're kind of at the end here. I did say today would be a bit quicker, but I want to just point this out, okay? On the news today, you have this occurring. Hey, this state, that state said they wanted to do ESG screening for the investments in their pension fund. They wanted to do ESG screening and they wanted to eliminate companies. I can tell you this. Before ESG even became a thing you would read about in the newspaper or a thing you would hear on the news, pension boards of states, pension boards of companies, pension boards of colleges, both private and public, would hire investment management firms to manage their money. When they went to manage their money, they would often put stipulations. You can only invest in this, and we would like you not to invest in that. This whole layer of ESG that has now come out and is inside of the news, so on and so forth, is nothing new, okay? Replace ESG with the board's demands. What you are hearing on the news is, oh my goodness, this whole ESG thing, because it was a state who did it with a pension fund, would mean that companies that don't meet that ESG criteria may have less access to, let's say, the bond market. Why? Because the California pension system is not going to buy those bonds, or their stock is going to be sold by the California Pension Board, called CalSTRS, because they don't meet that ESG criteria. Right wrong, or indifferent. This is the landscape in which we live in. And in addition to that, boards of pension funds, boards of companies, the, so on and so forth, with endowments, pension funds, so on and so forth, have always put criteria in. This is just maybe something new that's hitting. The criteria maybe didn't have anything to do with ESG, okay? But it's always existed. I can tell you from experience. I can tell you from experience. Individual investors have often put that same criteria on their portfolios. It doesn't need to be an ESG filtering. It could have been something as simple as, I don't want to invest in XYZ company, here's why. I hear it all day long talking to our retail investors, like many of you on the phone. What we do, what Triumph does, when we help our individual clients, we analyze their current situation. We help them with their investments. I should probably remove suitable here because it shouldn't be here. If our clients at the end of the day want an ESG overlay, we can absolutely do that. In fact, we manage 3 ESG models, an aggressive, a moderate, and a conservative one. Will we filter for ESG? Why do we do that? We do that because we have clients that say, hey, I want to be invested ESG, and then depending upon their risk tolerance, aggressive, moderate, conservative, so on and so forth, we provide that type of portfolio management for our clients. When it comes to the overall plan, but by the way, that's not all we do. We have more clients that don't have any, they don't care about the ESG thing at all. We just offer investment services, and because some clients want ESG, they can have ESG. It's not all we do, obviously. Working in the planning segment and the portfolio management, we set, realistic expectations for our clients for performance as well as their planning. And obviously, we monitor the portfolio and recommend changes over time. If you're not familiar with us, you can become familiar with us at www.triumphcapitalmanagement.com. You can read more about the firm. You can read more about what we do. If tonight's educational presentation on ESG, if you'd like to learn more about it, please feel free to reach out. If you want to talk more about it, please feel free to reach out. If you hate ESG and are on this because you want to scream at me, call me and scream at me. Again, this isn't a presentation about ESG, it's more a presentation about what it is, why it is, what you're hearing in the news, and the criteria that goes into it. Like all things, it's flawed in many ways, but in many other ways, it's not flawed. If you're an investor who very much cares about these things, having an ESG filter, you can absolutely do. Yes, we use third-party grading systems, but it is what it is. It's no different than how grading systems work in almost everything. This is the end. You have our contact information again here. You have my personal email right there, my work email, I should say. My direct phone number if you'd like to call me and discuss ESG, or if you want to call me and scream at me, or you want to call me and congratulate us for whatever. But anyways, I hope tonight was somewhat insightful. Whenever I hear about ESG in the news, whenever I hear about ESG in the paper or read about ESG in the paper, when I was listening to the podcast last night and Joe Rogan and his guest were talking about ESG, Joe Rogan asked the guest 3 or 4 times, what is ESG? What is ESG? What is ESG? His guest, very smart person, liked the guy, respect the guy, but he couldn't really answer it. I found it very funny that tonight I'd be doing this and I could easily say what ESG investing is, what ESG investing is not, and my point when it comes to investing. You take a step back. Governments around the world have committed to net zero greenhouse gas emissions over the coming decades. With that type of commitment from countries, It will change the landscape. That is one of the reasons why I spent so much time on the E, the environmental. The other areas of social and governance are also being played inside of there because of the screening systems that exist. Anyways, I'm signing off. Thank you for joining. And I hope you all have a great night. We'll have other educational presentations like this. When you visit our website, if you go to the area that talks about webinars, you can sign up from them there. And of course, you'll all get some emails. Thanks again. Hope you had a good time, and talk to y'all soon. Bye-bye.